US equities market is currently demonstrating remarkable resilience, even as it faces a complex macroeconomic landscape. Investors are navigating a mix of challenges and opportunities, but the overall tone remains optimistic. This optimism is largely fueled by record-setting corporate earnings and a surge in investments, particularly in the technology sector. As we look closer, it becomes clear that the driving force behind this resilience is not just traditional business growth, but a new wave of innovation. The market's ability to adapt and thrive is setting the stage for what could be a transformative period in US financial history. The heart of this transformation is the artificial intelligence infrastructure boom. What was once a speculative story has now become a concrete reality, with companies pouring unprecedented amounts of capital into AI development. This shift is not just about software or algorithms, it's about building the physical backbone, servers, chips, and data centers that will power the next generation of technology. The scale of investment is staggering, and it's fundamentally changing the way businesses operate and compete. As AI infrastructure expands, it's creating ripple effects across the entire market. Artificial intelligence trade has officially moved beyond hype. Investors and companies alike are no longer just talking about the potential of AI, they're acting on it. This transition marks the beginning of a capital expenditure supercycle, where real money is being spent to make AI a core part of business operations. The narrative has shifted from speculation to execution, and the results are already visible in the market's performance. This is a pivotal moment, as the focus turns to tangible outcomes and measurable growth. Prime example of this new reality is Dell Technologies. The company recently experienced a surge of over 30% in its stock price following a massive earnings beat. What drove this impressive performance? Robust demand for AI servers. Dell's success highlights how companies that are positioned to supply the essential tools for AI development, the so-called picks, and reaping significant rewards. This isn't just a one-off event. It's a sign of a broader trend that's reshaping the tech sector. Now in what many call the picks and shovels phase of the AI build-out. This means that the companies providing the essential hardware and infrastructure for AI, like servers, chips, and networking equipment, are at the center of the action. These businesses are expected to drive about 40% of the S&P 500's earnings growth this year. It's a massive opportunity, and it's attracting attention from investors who want exposure to the foundational elements of the AI revolution. Impact of AI infrastructure spending is already being felt in the broader market. Analysts estimate that this wave of investment will account for roughly 40% of the S&P 500's earnings growth in the current year. This is a significant contribution, highlighting just how central AI has become to the financial health of America's largest companies. As these investments continue, they're likely to drive even more growth and innovation across multiple sectors. Major hyperscalers, those massive tech companies that run the world's largest data centers, are leading this investment wave. They're projecting over $670 billion in capital expenditures through 2026. This level of spending is unprecedented, and it's creating a huge liquidity funnel into the semiconductor and tech hardware sectors. These investments are not just about keeping up with demand, they're about building the future of digital infrastructure. All of this investment and growth is helping to keep the Nasdaq trading near historic highs. The tech-heavy index is benefiting from the surge in AI-related spending, as well as strong earnings from leading technology companies. Investors are watching closely, as the Nasdaq's performance often signals broader trends in the market. The current environment suggests that technology will remain a key driver of market momentum for the foreseeable future. As we look to the future, the US equities market appears poised for continued growth, powered by the ongoing boom in artificial intelligence infrastructure. The combination of record earnings, massive capital investments, and technological innovation is creating a dynamic environment full of opportunity. While challenges remain, the market's resilience and adaptability suggest that the best may be yet to come. Investors and companies alike are preparing for what could be a new era of growth and transformation. Welcome to our exploration of how geopolitical tensions are shaping global energy markets. In recent months, optimism fueled by technological advancements has been counterbalanced by persistent supply-side uncertainties. These uncertainties are largely rooted in the Middle East, where ongoing conflicts and diplomatic standoffs continue to impact the flow of energy resources. As we dive deeper, we'll examine how these geopolitical headwinds influence oil prices, inflation, and broader economic trends. Let's start by understanding the current situation in the Middle East and why it matters so much for global energy. Middle East remains a focal point for supply-side uncertainty in energy markets. Despite a quasi-ceasefire, the region is far from stable. The ongoing standoff between the United States and Iran has kept the Strait of Hormuz, a critical passage for oil shipments, highly restricted. This restriction means that any escalation or disruption could have immediate effects on global energy supply. The world watches closely, knowing that even minor incidents can ripple through markets, affecting prices and economic stability. These tensions are not just regional, they have global implications, especially for countries dependent on imported energy. Strait of Hormuz is one of the world's most important energy choke points. About a third of global oil shipments pass through this narrow waterway. With heightened restrictions due to geopolitical tensions, the flow of oil is closely monitored. Any disruption here can quickly push up global energy prices, creating ripple effects across economies. The ongoing standoff has kept the strait highly restricted, ensuring that energy prices remain elevated. This situation underscores the vulnerability of global supply chains and the importance of diplomatic stability in the region. Brent crude oil, a benchmark for global energy prices, has been fluctuating near the $90 per barrel threshold. This price level reflects the ongoing supply-side risks and the market's sensitivity to geopolitical developments. While these fluctuations create localized inflationary pressures, they also signal the market's ability to adapt and absorb shocks. Investors and policymakers closely track these movements, understanding that oil prices influence everything from transportation costs to consumer goods. The current environment is one of cautious optimism, with markets digesting risks efficiently. Rising energy prices have a direct impact on inflation. When oil prices climb, transportation and production costs increase, leading to higher prices for goods and services. This localized inflation can complicate central banks' strategies, especially in the United States. The Federal Reserve must weigh these pressures when considering potential interest rate cuts. While energy-driven inflation is a challenge, it is not viewed as an insurmountable threat. Instead, it's seen as a manageable headwind that requires careful policy responses and market monitoring. Federal Reserve faces a complex landscape as it considers the timing of potential interest rate cuts. Energy market volatility adds another layer of uncertainty to its decision-making process. While inflationary pressures from rising oil prices are real, the broader market has shown resilience. The Fed's challenge is to balance these risks without derailing economic recovery. By monitoring energy trends and geopolitical developments, policymakers aim to keep inflation in check while supporting growth. This delicate balancing act is crucial for maintaining stability in uncertain times. Despite the ongoing geopolitical risks, the broader market has digested these challenges with remarkable efficiency. Investors and businesses have adapted to the new normal, viewing energy constraints as manageable rather than systemic threats. This adaptability is a testament to the resilience of global markets and the effectiveness of risk management strategies. By staying informed and flexible, market participants continue to navigate uncertainties, ensuring that economic activity remains robust even in the face of headwinds. Technological advancements drive optimism in many sectors. Energy market risks remain a counterbalancing force. The interplay between innovation and supply-side uncertainty shapes the outlook for global growth. As tech-driven progress continues, it's important to recognize the persistent influence of geopolitical factors. Markets must balance enthusiasm for innovation with caution regarding energy supply disruptions. This dynamic creates a complex but manageable environment for investors, policymakers, and consumers alike. Summary: geopolitical headwinds from the Middle East continue to influence global energy markets, keeping prices elevated and creating inflationary pressures. However, the broader market has shown resilience, viewing these risks as manageable. The Federal Reserve and other policymakers remain vigilant, balancing inflation concerns with growth objectives. As technology drives optimism, energy market uncertainties remind us of the importance of adaptability and strategic planning. By understanding these dynamics, we can better navigate the challenges and opportunities ahead. In the face of elevated interest rates and ongoing geopolitical tensions, corporate America is showing remarkable resilience. Companies are not only weathering the storm, but are thriving, demonstrating exceptional pricing power. This strength is evident in the latest earnings reports, which have surprised analysts and investors alike. The ability to maintain robust profits despite challenging macroeconomic conditions speaks volumes about the adaptability and strategic prowess of these corporations. As we dive deeper, let's explore how this resilience is shaping the broader market outlook and what it means for investors moving forward. First quarter of this year has been nothing short of extraordinary for the S&P 500. Earnings expanded by roughly 28% year-over-year, a figure that far exceeds Wall Street's modest expectations of mid-single-digit growth. This surge in corporate profits has caught many by surprise, highlighting the underlying strength of the market. Such robust earnings growth is not only a testament to the operational efficiency of these companies, but also their ability to navigate and capitalize on challenging environments. Let's take a closer look at what's driving this impressive performance. Wall Street analysts had anticipated only modest gains for the S&P 500, expecting mid-single-digit growth in earnings. However, the actual results blew these forecasts out of the water. This massive influx of profit has fundamentally changed the narrative, shifting sentiment from cautious optimism to outright confidence. The ability of corporate America to outperform even conservative estimates is a clear indicator of strong market fundamentals. This scene sets the stage for understanding how such earnings surprises impact market valuations and investor behavior. This influx of corporate profit, market valuations are being compressed. The current forward price-to-earnings (PE) multiple for the S&P 500 stands at roughly 21 times, which now appears much more justifiable to institutional investors. This means that, despite higher prices, the underlying earnings growth is making stocks look more attractive from a valuation perspective. Investors are reassessing their strategies, recognizing that strong earnings can support higher valuations without increasing risk. Let's explore why this matters for both institutional and retail investors. Major financial institutions are taking notice of this fundamental earnings strength. With compressed valuations and robust profit growth, institutional capital is finding the current market environment increasingly appealing. Firms like Goldman Sachs are revising their forecasts upward, reflecting renewed confidence in the S&P 500's trajectory. This institutional optimism is a powerful driver, often influencing broader market trends and investor sentiment. As we move forward, it's important to understand how these forecasts shape expectations for the rest of the year. Powered by strong earnings, major institutions are now forecasting the S&P 500 to reach new heights. Goldman Sachs, for example, projects the index to hit the 7,600 level by year-end. This bullish outlook is grounded in the fundamental strength of corporate profits and the ability of companies to maintain growth despite external pressures. Such forecasts are not just numbers, they reflect a broader belief in the resilience and adaptability of corporate America. Let's examine what these projections mean for investors and the market as a whole. One of the key factors behind this earnings surge is exceptional pricing power. Companies are able to pass on costs to consumers without sacrificing demand, maintaining profit margins even as input costs rise. This pricing power is a sign of strong brand value and market positioning, allowing firms to thrive in a competitive landscape. Understanding how pricing power works can help investors identify companies with sustainable growth prospects. Let's break down this concept and see why it's so crucial in today's market. For investors, these developments mean new opportunities and challenges. The combination of strong earnings, compressed valuations, and institutional confidence is reshaping investment strategies. Many are now looking for companies with proven pricing power and robust profit growth, seeing them as safer bets in an uncertain environment. This shift is also encouraging more long-term thinking, as investors recognize the importance of fundamentals over short-term market noise. Let's discuss how these trends are influencing portfolio decisions across the board. As we look toward the end of the year, the outlook for the S&P 500 remains optimistic. The unprecedented resilience in earnings, combined with institutional forecasts and compressed valuations, suggests that the market is well-positioned for continued growth. While challenges remain, the fundamental strength of corporate America is providing a solid foundation for investors. Staying informed and focusing on companies with strong pricing power and profit growth will be key to navigating the evolving landscape. The story of earnings resilience is far from over, and the next chapter promises even more excitement.